Now, it looks like Cuba may be next, but the larger story is not Cuba. The larger story is oil. The larger story is dollars. The larger story is leverage. And the larger story is that one of the most important monetary arrangements of the last half-century is beginning to show cracks in public. The United Arab Emirates, a founding member of OPEC since 1967, has now told the world that it is leaving OPEC and OPEC Plus effective May 1st. On the surface, this looks like an energy story. It looks like a disagreement inside an oil cartel. It looks like a supply issue, a gas price issue, a geopolitical issue. But in systems, the headline is rarely the whole story. The headline is UAE leaving OPEC. The underlying mechanism is the weakening of the petrodollar system. That distinction matters. Because if you only look at the oil price, you miss the power structure underneath it. Markets are reacting to the supply shock. Gasoline prices are rising. The paper price of oil has moved over $100 a barrel. Consumers feel it at the pump. Investors see it in energy stocks, inflation expectations, and bond yields. But the most important part is not simply that oil is expensive. It is that, for the first time in a very long time, the United States is being pressured by one of its closest Gulf allies in a way that reveals how much leverage those allies still hold over American financial markets. A few days before the UAE announced it was leaving OPEC, it issued a warning. It said that if it ran low on dollars because of the Iran war, it might be forced to use yuan or other currencies. That is not a small statement. In plain language, the message was this: if our dollar liquidity becomes too tight, we can begin pricing oil differently, and we can sell us assets to raise the dollars we need. That is leverage. The United States responded with concern because Gulf states collectively hold more than $2 trillion in U.S. assets, treasuries, equities, dollar-denominated financial claims. If those assets are sold disorderly, U.S. markets can become unstable. So when Treasury officials talk about swap lines to maintain order in dollar funding markets and prevent disorderly sales of U.S. assets, they are saying something very important. They are saying the Gulf states own enough American assets that their selling can threaten American market stability. That means the relationship is not simply one side commanding and the other side obeying. It is a balance of dependencies. The United States provides security, dollars, weapons, and market access. The Gulf states provide oil flows, dollar recycling, and demand for U.S. financial assets. When one side is disrupted, the entire arrangement becomes fragile. And that is why the UAE leaving OPEC is not just an oil story. It is a power story, it is a monetary story, it is a story about what happens when a 50-year arrangement begins to lose the conditions that made it work. To understand it, you have to go back to 1971. That is when President Nixon closed the gold window. Before that, the dollar still had a formal link to gold. After that, the dollar was no longer backed by gold, it became pure fiat. It was backed by trust, institutions, military power, taxation, and global acceptance. Now ask a simple question. If you are an oil-producing country sitting on a finite resource, why would you sell that resource for a currency that can be created in unlimited amounts? That is not an emotional question. It is a rational question. Oil is real. It is scarce. It is geologically limited. It powers transportation, industry, military logistics, agriculture, and the global economy. A fiat currency is a claim. If the claim can be created too easily, the seller of the real asset needs compensation, protection, and a system that makes the currency useful. That is where the petrodollar arrangement came in. In 1974, Henry Kissinger went to Saudi Arabia and helped build the arrangement that became known as the petrodollar system. The essential logic was simple. Saudi Arabia would price oil in U.S. dollars. Oil revenues would be recycled back into U.S. Treasury bonds and other dollar assets. In return, the United States would provide military protection, weapons, and security support. This was an extraordinary arrangement for the United States. Every country needed oil. If oil was priced in dollars, every country needed dollars. That created structural global demand for the U.S. dollar, even though the dollar was no longer backed by gold. In effect, after the dollar lost gold, oil became the anchor, not formally in the way gold had been, but structurally the world needed oil, so the world needed dollars, and the dollars earned by oil producers were recycled into U.S. debt, helping finance the American state. That is the system. OPEC then played a role in maintaining oil supply discipline among producing nations. It helped manage the oil price environment that made the dollar-denominated oil system workable. OPEC was not merely an oil cartel in this framework. It was part of the enforcement architecture around the dollar's new anchor. Now we are in a very different world. The old petrodollar agreement has expired or weakened. Saudi Arabia is no longer bound in the same way. China is a much larger customer. The United States is running large deficits. The dollar's share of global reserves has declined. Central banks are buying gold. The U.S. has weaponized dollar reserves against adversaries. The Gulf states are increasingly playing multiple sides. That is the backdrop. Then the Iran war begins. Then the Strait of Hormuz becomes the choke point. The Strait of Hormuz is not just a narrow waterway. It is one of the most important pressure points in the world economy. Around 20% of global oil and gas supply moves through it. Oil from Saudi Arabia, the UAE, Kuwait, Qatar, Iraq, and others depends on this route to reach global markets. When Hormuz is effectively closed or constrained, the Gulf economic model comes under pressure. That is because these countries do not simply produce oil. They rely on exporting it, receiving dollars, maintaining dollar pegs, funding governments, and supporting domestic social and political stability. Take Saudi Arabia before the war. Saudi Arabia needed oil around $100 a barrel to cover basic government spending, imports, and social programs. It was exporting millions of barrels per Dalton Y to support that system. If the export volume collapses, the price has to rise dramatically to generate the same revenue in the source framework. One economist estimated Saudi Arabia might need oil around $170 a barrel to make up the revenue gap. But the paper price is not there. Oil may be above $100, but not high enough to fully replace lost volume. So the Gulf states face a difficult math problem. Their oil exports are constrained, their dollar income falls, their dollar reserves come under pressure. Their currencies are often pegged to the dollar, so they need dollar reserves to maintain confidence in those pegs. And if the war that created the crisis was started or escalated by their ally, then their ally becomes both protector and source of pressure. That is a dangerous dynamic when a country runs low on dollars but owns large U.S. assets. It has a choice. It can ask for dollar liquidity through swap lines, or it can sell us assets. If it sells us assets, U.S. markets can be destabilized, so the request for swap lines is not just a request for help. It is a negotiation backed by financial leverage. The Gulf states can say, we need dollars. We hold your assets. You do not want us to sell them disorderly. So provide liquidity. That is what is happening. And this is where China enters the story. The UAE first strengthens its relationship with China. It meets with Chinese leadership. It signs trade and investment deals. It signals a willingness to deepen economic links with Beijing. Then it warns about using yuan or other currencies. Then it receives us attention over dollar swap lines. Then it leaves OPEC. This sequence matters. It shows the UAE is not simply reacting to oil market conditions. It is using its strategic position between the United States and China to gain concessions. That is how smaller powers operate when great powers compete. They do not have to defeat the larger power. They only have to create credible alternatives. If Washington believes Abu Dhabi has a real China option, Washington has to respond differently. That is leverage. China benefits from this because it has spent years building alternatives. China built manufacturing capacity. It secured commodity supply chains. It invested in ports. It developed rare earth processing dominance. It created payment systems alongside the Western system. It built yuan clearing infrastructure in major financial centers. It bought oil from sanctioned countries. It waited for moments when the dollar system's weaknesses would become visible. Now those weaknesses are visible. One major weakness is the dependence of the U.S. military and industrial system on Chinese-controlled materials. Modern weapons require rare earths, tungsten, advanced components, and industrial inputs that China dominates in mining or processing. If the United States is engaged in a conflict and uses up key missile stockpiles, replacing those stockpiles is not simply a matter of printing money. You cannot print a missile. You cannot print rare earth processing capacity. You cannot print industrial supply chains that took decades to build elsewhere. That is the difference between financial power and industrial power for 50 years. The United States operated as if printing dollars and recycling them through financial markets could substitute for making things. China did the opposite. It made things. It built capacity, it secured raw materials, it developed infrastructure. Now in a crisis, the difference matters. Paper assets can finance a war, but physical capacity fights one. That is why the dollar system is under pressure, because the country that issues the reserve currency still has financial dominance. But the country that produces and processes critical materials has real-world leverage. This is what I mean when I say the system is changing from a purely financial order to a financial industrial order. Money still matters, but production matters again, energy matters again, commodities matter again, supply chains matter again. The next phase of the global monetary system will be shaped by this conflict between financial claims and physical capacity. Now, what does this mean for the dollar? The dollar is still the world's most important reserve currency. It has the largest market, the deepest treasury system, the most powerful financial network, and enormous institutional advantages. But dominance is not the same as monopoly. In 2001, the dollar made up around 72% of global foreign exchange reserves. Today, that share has fallen into the 50s. That is still large, but it is not what it was. The decline tells you that central banks and governments are slowly diversifying away from dollar dependence. What are they buying instead? Gold. Central banks have been buying gold at the fastest pace in decades. This is important because central banks are usually conservative institutions. They do not move into gold for entertainment. They buy gold when they want an asset outside another country's liability system. A treasury bond is an asset to the holder, but it is also someone else's liability. Gold is not another government's liability. That distinction became much more important after 2022, when the United States and its allies froze Russia's foreign exchange reserves. From the Western perspective, that was a financial weapon used against an aggressor. From the perspective of every other central bank, it created a terrifying precedent. If your reserves are held in dollars and treasuries, and if those reserves can be frozen, then they are not fully yours in a political crisis. Every country saw that. They did not all say it publicly, but they saw it. And they began to ask, could this happen to us? That is why gold became more attractive. Not because gold yields interest, it does not. Gold is attractive because it is outside the dollar liability system. When trust in the neutrality of dollar reserves weakens, gold becomes a substitute form of reserve confidence. That is the structural shift. At the same time, China has been building alternative plumbing. Yuan clearing banks operate in London, Dubai, Singapore, Hong Kong, Switzerland, and other key hubs. Commodity deals are increasingly being discussed or executed in yuan. Iran has sold oil to China in yuan. Russia has shifted trade settlement after sanctions. India has experimented. Large mining companies have signed yuan-based commodity arrangements with Chinese buyers. The alternative system is not replacing the dollar overnight. That is not how reserve currency systems die. They do not collapse in one day. They erode. They fragment. They become multipolar. They become less automatic. Participants hedge. They hold more gold. They settle some trade in other currencies. They demand higher yields to hold us debt. They still use dollars, but they do so with more caution. That is the phase we are in. Now, bond markets tell us a lot about this stress. When investors become concerned about U.S. debt, inflation, war, or currency risk, they demand higher yields to hold treasuries. In the source framework, the 10-year treasury yield near 4.4% became an important stress level. Each time yields approached that level around major war headlines, U.S. policy language seemed to shift toward calming the situation. This suggests a deeper truth. The bond market is constraining foreign policy. That may sound extreme, but it is logical. If the U.S. government depends on borrowing at manageable rates, then a disorderly treasury market becomes a national security problem. A government with large debt cannot ignore the bond market. If yields rise too far too fast, debt service becomes more expensive, stock valuations come under pressure, mortgages become more expensive, banks face losses, and the economy tightens. So when geopolitical escalation causes yields to rise, policymakers must think about financial stability. That means the bond market has a vote. It can say, if you escalate this war, pay me more. And if the government cannot afford to pay much more, the bond market becomes a constraint on policy. This is one of the clearest signs that the old system is strained. A financially dominant country can project power when its debt markets are trusted and liquid, but if those markets begin to revolt, power projection becomes more costly. Now, the swap lines create a short-term solution. If Gulf allies need dollars and the U.S. provides liquidity, that can prevent disorderly asset sales and stabilize dollar funding markets. But it can also create a larger problem if Hormuz remains constrained. Because if you inject dollar liquidity into countries facing an energy supply shock, you may stabilize the financial system temporarily while also supporting demand for scarce commodities. That can push commodity inflation higher. Commodity inflation is dangerous for bonds because investors do not want to hold bonds that are being inflated away in real terms. So policymakers may be trading short-term treasury stability for longer-term inflation pressure. That is the dilemma. If you do not provide dollars, Gulf states may sell us assets disorderly. If you do provide dollars, you may help fuel commodity inflation while the supply choke point remains. There is no clean option. That is what a system under stress looks like. Now, how does this end? The source framework describes two broad endings, and both are bad. In the first ending, Iran collapses or is broken. If that happens, Iranian oil may go offline for a long time. The shock can push oil prices higher, create inflation, trigger recession, and stress bond markets. In the second ending, the global supply chain breaks before Iran does. If Hormuz remains closed or constrained, oil, gas, and fertilizer flows remain disrupted. Inflation rises, food prices rise, global growth weakens, bond markets come under pressure, recession risk rises. The U.S. strategy may be to extend the ceasefire, maintain pressure, and wait for Iran to break first. But Iran's allies also have a strategy. Russia can support Iran, China can buy its oil. Iran can keep Hormuz constrained and force the economic pain outward. This is why the war is not only military, it is economic. The battlefield is oil flows. The battlefield is fertilizer. The battlefield is shipping insurance. The battlefield is treasury yields. The battlefield is dollar funding. The battlefield is reserve confidence. The battlefield is the balance between financial claims and physical goods. This is how modern great power conflict works. It is not just tanks and missiles. It is payment systems, commodities, supply chains, reserves, debt markets, and inflation. The Strait of Hormuz also handles a large share of the world's fertilizer trade. That matters because fertilizer is not just an agricultural input. It is one of the reasons the modern world can feed billions of people. If fertilizer trade is disrupted, the effect does not stop at energy prices. It moves into food prices. It moves into political stability. It moves into emerging markets. It moves into social stress. Food inflation is one of the most politically dangerous forms of inflation because people feel it immediately and cannot avoid it. Higher oil prices raise transportation costs, higher fertilizer costs raise agricultural costs together. They can create a food inflation cycle. That is why Hormuz is not just about gasoline, it is about the price of bread, it is about the price of meat, it is about the stability of governments, it is about the global social contract. Now, what does this mean for portfolios? This is where investors have to be very sober. The stock market is pricing in a very favorable set of assumptions. It is assuming that AI productivity will continue to support earnings. It is assuming the Iran war will end quickly or remain contained. It is assuming oil and fertilizer shocks will not break inflation. It is assuming bond markets will remain functional. It is assuming liquidity can solve the problem. If any of those assumptions are wrong, valuations can change quickly. One useful framework described in the source is an adjusted version of the Warren Buffett indicator. The classic version compares total stock market value to GDP. The adjusted version subtracts federal debt from GDP to account for the fact that debt and money printing have changed the economy's structure. In that adjusted framework, there have been only a few moments in the last 70 years when the indicator moved above 100% of GDP, the peak of the dot-com bubble in 2000, the everything bubble peak in 2021. And now, in the prior cases, the market fell sharply from peak to trough between roughly 25% and 47%, and took years to recover. Both periods were favorable for gold relative to stocks. That does not guarantee the same outcome. Now, but it tells us the market is not priced for stress. It is priced for a smooth outcome, and the environment is not smooth. Hormuz remains constrained. Food inflation pressure is rising. U.S. missile stockpiles and industrial capacity are under strain. China is signing commodity deals in yuan. Gulf states are receiving dollar swap lines while threatening to diversify. Central banks are buying gold. Treasury yields are constraining policy. That combination is not normal. When markets price perfection in a non-perfect world, risk rises. That does not mean sell everything. I do not think that way. A good investor does not respond to complexity by panicking, but it does mean position sizing, cash, hedges, gold, energy exposure, and liquidity become more important. It means the investor should ask what assets do well if inflation persists, oil rises, and trust in treasuries weakens. It also means the investor should ask what assets suffer if yields rise, earnings estimates fall, and liquidity tightens. Stocks can still rise, AI can still be powerful. The U.S. market can still be the best long-term market in the world, but good long-term assets can still be overpriced in the short term, and a great country can still face a bad cycle. Those two ideas can both be true. I would be cautious, not because I know exactly what happens next, but because the range of outcomes is wider than the market appears to be acknowledging. Cash is not a perfect asset because inflation eats cash, but cash is optionality. In a market downturn, cash becomes the ability to buy. Gold is not a perfect asset because it produces no cash flow, but gold is outside the liability system. Energy is volatile, but energy can protect against supply shock. Broad equities remain important long-term, but equities can suffer if inflation and rates rise together. The portfolio question is not, what will go up tomorrow? The portfolio question is, what mix allows me to survive the different paths this system could take? That is how I would think. Now let us step back and connect the whole chain. The UAE leaves OPEC. Before that, it threatens yuan pricing and asset sales if dollar shortages intensify. The U.S. responds with discussion of swap lines because disorderly US asset sales would threaten markets. This reveals the Gulf states' financial leverage. The leverage exists because of the petrodollar system. That system began after the dollar lost gold backing. Oil became the dollar's structural anchor. Saudi Arabia and OPEC helped maintain the arrangement, but the agreement weakened and the world changed. The Iran war and the closure or disruption of Hormuz stressed the Gulf economic model. Gulf states need dollars to maintain pegs and finance economies. China offers an alternative relationship. The UAE uses the China relationship as leverage against Washington. China's industrial dominance, rare earth control, and alternative payment infrastructure become strategic advantages. The dollar's reserve share declines. Central banks buy gold. The freezing of Russia's reserves accelerates distrust of dollar assets. Treasury yields rise when war risk rises. Bond markets constrain us. Foreign policy. Swap lines buy time but may worsen commodity inflation if the supply shock persists. The possible endings are inflationary and recessionary. Stock valuations are pricing in a benign outcome. Gold, energy, cash, and hedges become more important to think about. That is the system, and that is why this is not just an oil story. It is about the next phase of the monetary order. The petrodollar system was built on a deal: oil for dollars. Dollars for treasuries, security for recycling. That deal worked for decades because the U.S. was dominant militarily, financially, and industrially enough to make the arrangement attractive. But if the U.S. becomes more financially dominant than industrially dominant, and if China becomes more industrially essential while building alternative financial rails, then the old system becomes less stable. The world does not need to abandon the dollar all at once. It only needs to need the dollar a little less. It only needs to hold a little more gold. It only needs to settle a little more trade in yuan. It only needs to demand a little more yield for treasuries. It only needs to diversify one step at a time. That is how reserve systems change slowly. Then suddenly in moments of stress. Now I want to be clear. The dollar is not disappearing tomorrow. The United States is not weak in an absolute sense. It still has enormous advantages: deep capital markets, rule of law relative to alternatives, technology, military power, energy production, alliances, and institutional depth. But the direction matters. A dominant system can weaken gradually while still being dominant. Rome was still Rome after the first cracks appeared. The British pound was still important long after its peak. The dollar can remain central while becoming less monopolistic. That is the point. The risk is not immediate disappearance. The risk is erosion of privilege. If the dollar loses some reserve privilege, the United States must pay more for capital. It becomes harder to run large deficits. Inflation becomes harder to contain. Military projection becomes more expensive. Asset markets lose some automatic support that affects everyone. It affects the cost of mortgages. It affects stock valuations. It affects gas prices. It affects gold. It affects Bitcoin. It affects foreign exchange. It affects the shape of retirement portfolios. It affects the price of food. It affects the entire financial system. That is why the petrodollar matters. It was not just a technical oil pricing arrangement. It was a pillar under American financial power. Now the pillar is being tested, and when a pillar is tested, the structure above it can shake. Now, let me think about Bitcoin briefly because the source mentions it as part of the broader portfolio implications. Bitcoin is often seen as a hedge against fiat debasement and censorship risk. In a world where reserve assets can be frozen and money can be printed, some investors see Bitcoin as digital scarcity outside the traditional banking system. That thesis may become more attractive when trust in sovereign reserves declines. But Bitcoin is also volatile, liquidity sensitive, and still behaves at times like a risk asset. In a severe market crash, it can fall sharply, even if the long-term thesis strengthens. Gold has a longer history as a reserve asset. Bitcoin has a shorter but more technologically native claim on scarcity. Both can respond to distrust in fiat systems, but they carry different risks. The investor should not confuse them. Gold is ancient trust. Bitcoin is digital scarcity. Both sit outside traditional fiat, but they behave differently. Now, energy is more direct. If Hormuz remains constrained, oil prices can rise. That can help energy producers and oil exposure. But high oil can hurt the broader economy. It can reduce consumer spending, raise inflation, force central banks into difficult choices, and pressure equity valuations. So oil can be both hedge and threat. That is how commodities often work in a portfolio. They can protect against the very shock that hurts other assets. But if the shock resolves, they can fall. This is why position sizing matters. A hedge is not a religion, it is a tool. Gold is similar. If bond markets lose confidence and central banks keep buying gold, gold can benefit. If real yields rise strongly and the dollar strengthens, gold can face pressure. But in a system where reserve trust is eroding, gold has a strategic role. Cash is also a tool. It gives optionality. But if held too long during inflation, it loses purchasing power. Every asset has strengths and weaknesses. The investor's job is to balance them based on the environment. Now, the environment described here is one of widening geopolitical and monetary tails. That means the probability of extreme outcomes is rising. A calm portfolio built only for smooth growth may not be enough. You need to think about shocks: oil shock, bond shock, dollar shock, gold rally, equity drawdown, inflation spike, recession, liquidity injection, policy reversal, supply chain disruption. These are not predictions, they are scenarios. Good investors do not need certainty, they need preparedness. Now, what should ordinary investors take from this? First, understand that gas prices are not isolated from geopolitics. Second, understand that oil pricing is not isolated from the dollar system. Third, understand that the dollar system is not isolated from U.S. debt. Fourth, understand that U.S. debt is not isolated from bond yields. Fifth, understand that bond yields are not isolated from stock valuations. Sixth, understand that central bank gold buying is not random. Seventh, understand that China is building alternatives to dollar settlement. Eighth, understand that energy, food, and fertilizer shocks can create inflation even when the financial system wants calm. Ninth, understand that if markets price perfection, any disruption can cause large repricing. 10th, understand that cash, gold, energy, and diversified assets have different roles in different parts of the cycle. That is the framework. Now, if I had to describe the current system in one sentence, I would say this. The United States is trying to preserve financial dominance in a world where physical supply chains, energy flows, and alternative monetary rails are becoming more important. That is the core. The old world said dollars and treasuries were enough. The new world is asking who controls oil routes, rare earths, fertilizer, shipping, energy infrastructure, gold reserves, and payment systems. That is a much harder world for purely financial power. It does not mean financial power disappears. It means it must compete with physical power again. Now, let us return to the UAE. Why does leaving OPEC matter? Because OPEC helps stabilize the old oil-dollar arrangement. A founding member leaving during an energy crisis signals that national interest is overriding cartel discipline. The UAE wants flexibility. It wants to meet changing demand. It wants to manage its own exports. It wants leverage with both Washington and Beijing. It wants dollars when needed, but it also wants alternatives. That is rational from its perspective, but it weakens the old system. If more oil producers begin acting independently, pricing flexibly, accepting other currencies, diversifying reserves, and playing great powers against each other, then the petrodollar arrangement becomes less automatic. The dollar can still be used, but the system loses some of its inevitability. That is what markets are starting to sense. And the problem with systems built on confidence is that confidence can erode slowly until a crisis forces everyone to acknowledge what had already changed. Now, what is the risk to us assets? If Gulf states sell treasuries or equities to raise dollars, that can pressure markets. If they receive swap lines instead, direct selling may be avoided. But the underlying problem remains if export income is still impaired. If oil prices rise, inflation rises. If inflation rises, bond yields rise. If bond yields rise, stock valuations fall. If stock valuations fall, household wealth falls. If household wealth falls, confidence falls. If confidence falls, recession risk rises. That is the chain. This is why a crisis in a waterway can end up affecting a retirement account. The world is connected through balance sheets. Now, what would make the situation improve? Hormuz reopening safely, oil flows normalizing, a credible ceasefire or settlement, Gulf dollar reserves stabilizing, no disorderly sale of US assets, Treasury yields staying contained, inflation expectations falling, China and the US avoiding escalation, supply chains remaining functional. If those things happen, markets may look through the crisis. But what if they do not? Then the system has to reprice. Investors must think probabilistically. The market may still be right, but if the downside is large and the market assigns it too low a probability, caution is justified. This is how I think about risk. Risk is not only what is most likely, risk is what can hurt you if it happens. Now, I will make the conclusion very plain. The end of the petrodollar is not a single event. It is a process. The UAE leaving OPEC is one signal, yuan oil threats are another signal, dollar swap lines to Gulf allies are another signal. Central bank gold buying is another signal. China's commodity deals in yuan are another signal. The declining dollar share of reserves is another signal. Treasury yields constraining foreign policy is another signal. Industrial dependence on China is another signal. No single signal proves the system is ending tomorrow, but together they show a system under stress. And when a system under stress is priced by markets as if everything will go smoothly, the investor should pay attention. The goal is not to panic. The goal is to understand, because if you understand the system, you can position with more humility. You can hold enough cash to use volatility. You can own some assets that benefit from monetary distrust. You can avoid overconfidence in richly valued equities. You can think about energy as a hedge against energy shock. You can think about gold as a hedge against reserve, system stress. You can think about Bitcoin carefully, not emotionally. You can think about bonds not only as safe assets, but as assets exposed to inflation and fiscal pressure. You can think about portfolios as systems, not piles of tickers. That is the advantage. The old petrodollar system made the dollar the center of oil reserves and U.S. financing. The new system may be less centered, more fragmented, more commodity-linked, more gold-aware, more inflation-prone, more multipolar. That does not mean the United States is finished. It means the environment is changing. And when the environment changes, the portfolios built for the last regime may not be perfectly suited for the next one. That is the lesson. This is not just about the UAE. It is not just about OPEC. It is not just about Cuba. It is not just about Iran. It is not just about oil above $100. It is about what anchors money when trust weakens. It is about what happens when allies need dollars but also have alternatives. It is about what happens when the country that issues the reserve currency depends on borrowing from the rest of the world while also using that currency as a weapon. It is about what happens when physical supply chains become more important than financial promises. And it is about what investors should do when the market prices a smooth future while the system underneath becomes more unstable. That is why I am cautious. Still invested because productive assets matter, but cautious because the range of outcomes is wider than most people think. That is how I would approach this moment. Not with certainty, not with panic, with a clear view of the system, a respect for risk, and a portfolio prepared for more than one possible future.